Hello friends, good morning to all of you, and this is a video related to the RBWM JAIIB, and we were covering the chapter number 6 from the module B. So do confirm the audio video quality at the earliest so that we can proceed with the video. And if you have not subscribed the channel so far, do subscribe to the channel at the earliest. So the last topic from the chapter number 6 module B, it's related to the product management. It's related to the product management. In the last video, we covered the different constraints for the new product development and also the stages of the product development. So there are 7 stages I have already told you, and the constraints we have already learned. And now it's about the last topic of the chapter number 6, that is related to the product management. And after that, one other topic, it's related to the product policy. So what is basically the product management? So product management means that the process we need to basically go through which the bank is going to plan, develop, launch, and manage and improve the product, right? Because the ultimate goal is what? That we want to satisfy the customer needs while we also want to achieve the organizational objectives like profitability, market share, customer retention, etc., etc. Right? We want to achieve those particular goals. And so for that particular purpose, we need to satisfy the customer needs, and for that particular case, we need to plan, develop, launch, manage, and improve the products, right? So the core basic objective of that is basically related to what? That we want to provide the right product to the right customer at the right time, and also with the right features and with the right pricing. So everything is to be right, like right product to the right customer at the right time with the right features and the right pricing, that is to be done. Now let's have a look at the types of product in the banking. First one, it's about the generic product. Now, generic product is the basic or fundamental service, like which is going to be offered to the customer without any special feature, without any branding, without any differentiation, like the core utility product, like saving product, saving account. Now, even if you open a saving account in PNB or SBI, it is not going to make a difference. It's just a generic product, like a current account, like a term deposit account, like a bank draft, demand draft. These are the core services. There is no differentiation. Like even if you compare from bank to bank basis, now there are no differences between it, right? And it's a basic financial functionality. It will be basically be having the basic financial functionality, and it will be same across all of the banks. Clear with it? So that is a generic product. Second one, it is a expected product. Expected product is basically representing the minimum, like let's say conditions or minimum attributes that the customer normally expect. Like we expect from the saving account that we'll be getting a checkbook, we'll be getting a ATM card, we'll be getting the internet banking, we'll be getting a passbook or statement. So that's basically the expected product. So minimum acceptable level of the service, which is acceptable, minimum level, the basic customer expectation we can say, that will be the expected product. Like a saving account that is going to provide you with the ATM services, internet banking, mobile banking, check facility, right? You can do the transactions through it. So that's the expected product. And what about the augmented product? The third one. So when you are adding additional features to it, value added services to the product, so as to differentiate our product from the others product, from the competitor's product, that is said to be the augmented product, right? So let's say a bank is giving free insurance cover along with the saving account, that will be an augmented product. A credit card with the reward points or cashback, that will be a augmented product. So you are giving value added services so as to differentiate your product from your competitors, right? It provides much more convenience to the customers. So that's about it. So let's say if a saving account is there, saving fund account is there, and it's allowing you airport launch access. That will be augmented product. Now the fourth one, it's about the potential product. Now potential product is what? Like whatsoever the future improvements or innovations that can be done into a particular product so as to enhance it further, those can be introduced in future. That's a potential the product is having, right? So we'll be focusing on the long term product development and innovation possibilities. That is basically what that is a potential product. That right now we are offering this, and so as to differentiate, we are adding these value to it. That will be the augmented product. But what future scope it is going to have, that is going to be the potential product. Like the future innovations which are possible over there, and further the continuous improvement definitely is to be there, and technology driven features could be there. Like let's say we are providing the mobile banking facility, and through the AI we are providing it, we are integrating it through the AI, also has to manage the investments through the AI. So that will be the potential product. So that's about the types of product as per the product management in the banking, and this is definitely very important topic. So one, it is a generic product, that is a core product, right? No differentiation. Expected product, the minimum facilities that the customers do want. Augmented product, the features that we do add so as to differentiate it from the competitors. And the potential products that are future possibilities, right? Then it's about the product policy. Product policy is what? It is a strategy or the strategic framework that's basically used by the banks, which they use it for designing purposes, for managing the position, so as to develop the product portfolio. That is said to be the product policy. Like we develop a product and we talk about that what branding will be done, or how the packaging will be done, and what design it will be there, how it is going to differentiate from the other products of the from the competitors, how it's going to differentiate from our own products, right? That is about product policy. And what are the different basically elements in the product policy? Let's have a look at it. So first one, it's about the appraisal of the product line and the individual products. Appraisal means what? That we need to evaluate the product portfolio. We need to evaluate. Let's say we are having 10 products. Let's say PNB is offering 5 type of saving fund accounts: SF1, SF2, SF3. So they need to evaluate that are the products working all fine? Do we need to make any changes toward it or not? What is their effectiveness? Is the product profitable? What is the demand of this particular product? Are we competitive in the market? Is the positioning particularly good there? It's not like it's providing a competition to the product only, right? And are the products aligning with the business strategy or the objectives? So we need to take care of all the things. That's a product appraisal. But what about the product line? Like under the one particular range of the products, like for saving fund accounts, you are having 5 types of accounts. So that's basically one product line. That is a one product line. Okay. So we need to identify the weak products, like the products with the low demand and the profitability. We need to improve the features of the products so as to enhance and provide much more value to the customer. We need to basically remove the obsolete products, the products which are gone, like Mitra account is gone because the BSBD account is there. So we need to discontinue the outdated services, right? And we need to expand successful products. We need to increase their features. We need to basically add more value toward it so that we can grab much more market share. Clear with it? Like if you have considered previously, there was traditional passbook saving account, but now that's declining. There is decline in that particular account. So bank is to convert that to the digital saving account. That's basically the need of the hour. So that's about the appraisal of product line and the individual products. That's the first element of the product policy. The second one, it's about the Decision on product differentiation. Now it is very much important. It's about the product differentiation. Like the which unique features are there or the benefits are there that are going to distinguish between a bank's product from its own products and also from the competitors. Like we are having the product P1 in one product line and product P2 in the same product line. How these are different, and also how P1 is different from the generic product of the competitor. That's the product differentiation. Now, differentiation could be technological, it could be pricing advantages, let's say you are having, or let's say you are providing the faster services, or let's say you're providing the customized solutions, whatsoever. So, bank A is offering a debit card, bank B is offering the debit card, but bank B is offering a personalized debit card. They are allowing you that you can print a photograph of yours on the debit card. So that's basically kind of differentiation, right? A differentiation that will be available. And the third one, it's about the product positioning, like how we want our product to be perceived by the customers, that what particular customer segment we want to target, and what is a unique value proposition that would be available, or what are the product benefits. Like the product is going to target the HNIs or students, or it's a digital account that will be targeting the tech savvy customers, right? So that's about it. And further, the fourth one, it's about the product branding. It's about the product branding. Now, what is branding? Like giving it the distinct identity. That's the branding, right? Like for the branding, we should be having a brand name, a logo, a signage, the brand value. Like for SBI, the product branded is like Yono. For HDFC, it's SmartUp account. For ICICI, it's InstaBiz. So that's basically the branded product name, right? So we should be having such things. And for the branding helps us for the customer retention purposes. It helps us for the product recognition, right? Like if we talk about we say the photocopy to be Xerox. Now Xerox is actually not a synonym of the photocopying. It's basically a brand. Xerox was a brand previously that was too much famous that nowadays we basically memorize Xerox as a synonym of the photocopy, but it's not the same. Okay. And for the then after that, it's about the packaging. It's about the packaging of the product. Packaging means we can be bundling multiple financial services under the one particular thing. Under the one particular thing. Now, when we are talking about the, let's say, salary package, right? For customers, like we can be making different packages. For salaried person, we made a salary package, which may be consisting of the saving fund account, right? Saving fund account and debit card and insurance, right? And premium banking package could be there, or business package could be there. So it's about the packaging. It's about the packaging. Then after that, it's about the new product development. It's about the new product development. Now, new product development refers to what? That we need to basically go through the process, that the banks need to identify the opportunities. They should be having the ideas with them. They should be doing the BMA, business analysis, market analysis is to be done. Proper product designing is to be done. And then testing is to be done. And after that, the commercial launch will be there. So, in case of the new product development, there are the different stages that we have already learned about, right? And it is done so as to attract the new customers, so as to increase the revenues, so as to retain the original customers, so as to adapt to the changing customer behavior. This is very much required. So 10 years back, there was lesser usage of the internet banking, mobile banking, but now people do use a lot. Now, basically, it's a era of the digital saving banks, contactless payment systems, green deposits, etc., etc. Right? So that's about the chapter number 6. That's the product development process. A very important chapter indeed, right? So after that, it's about the new chapter, chapter number 7. You have to start with. It's a chapter number 7, and it is about what? It is about the credit scoring. The next chapter that we are going to learn about, it's about the chapter 7. It's a credit scoring. So please do confirm that you have learned the content so far. If you're having any of the issues, any of the doubts, do let me know at the earliest. Do let me know at the earliest that you have any doubts. If you have understood the video so far, give this video a thumbs up and do share the video with your friends and colleagues who are preparing for the JAIIB 2026 exams. Right. So everything is working fine. After that, it's about the credit scoring. Now, why credit scoring is required? It is required for the so as to check the credit worthiness of the borrower. Like we want to check the credit worthiness of the borrower. Why? Because we want to quantify the risk associated with the customer. We want to quantify the risk associated with the customer. Now, what is risk? Risk is a possibility that we can be having a loss, we can be having a damage, or adverse consequences can be there, right? So that's about the risk. And let's say the risk could be related to customer. It would be like what? Like we have lent to the customer, but the customer is unable to pay. So that's a risk that we won't be getting back our repayments. Unable to pay. If the customer is unable to pay, the customer won't be paying you back, right? So that's the risk. So banks do undertake the multiple kind of activities. Like we do the lending activity. The bank is having the proprietary positions in the trading also in the through the treasury department, and also the bank is basically doing the investments also. So let's say if the investment interest rate is eroded, that's a risk to the bank. If the bank has lent money and it is not repaid, it's a risk to the bank. If the bank has invested money, right, into different markets, let's say money market, foreign exchange market, capital market, it's a risk to the bank. But particularly in this chapter, we are talking about the when the bank is lending, so the risk is involved. So we are to do what? We are to check the credit worthiness of the borrower beforehand. We are to establish the identity. That's basically the direction. That's basically the rule related to KYC ML. But also we are to check the credit worthiness of the borrower. We are to check the repaying capacity of the borrower. We are to check if the particular project is viable or not. So all the things are to be looked into. And the major thing is related to the credit worthiness and how we can do check the credit worthiness from the CIC, from the credit information company. And we are going to draw a report from the credit information company. You must have heard the name about Equifax or Experian or Sibyl. Sibyl is a most common one that we use, that we want to get the Sibyl score, right? So what is basic Sibyl score? It's ranging from 300 to 900, right? And further, when we are saying that the score is around 900, we say it's a very good score. And when we say the score is lower one, on the lower end, let's say it's 500, it means there was some delinquency, there was some default which was by the done by the customer in the history. So once a defaulter may again be a defaulter, so definitely that's the case. So we can basically we have to look into the different aspects thereon, right? And we it basically the this credit report is going to help us so as to take a decision. Okay, so let's first of all have a look at the types of the risks. The first one, it's about the credit risk. Credit risk is what? It is a possibility of the financial loss. So when you are lending money to the borrower, if the borrower fails to repay the amount, then basically it's not able to, let's say, fulfill the contractual obligation, then we say it to be the credit risk. And definitely this is the most common risk which is faced by the banks. That's the credit risk, right? So let's say the borrower defaulted or let's say the poor credit appraisal was there, or economic slowdown was there, or fraudulent borrower was there. So that's about the credit risk. The second type of risk is the business risk. It is the business risk. Now, business risk is basically what? Like the possibility of losses arising due to the internal operational inefficiencies, or let's say external market conditions were there which affected the company's profitability, right? So that's basically what, that's the business risk. Like the customer demand changed, or let's say there is now huge competition in the market. That's a business risk that is there due to the changing market scenarios, due to the business operations, those changed. Let's say previously there was monopoly of one brand, but now there are 20 brands. Now there is huge competition. Or let's say the technology changed. Now basically technology changed and you're not keeping yourself updated with the technology, right? Then definitely you will be losing the market share. So that's a business risk. And further, the third one, it's about the market risk. The market risk is like, it is also said to be the price risk. We also say the market risk to be the price risk. What is price risk? The adverse movement of the market interest rate, or let's say the adverse movement of the market variables which are going to change your profitability, right? Let's say the interest rate changed in such a manner that the prices moved adversely, or let's say the equity prices moved adversely. That's a market risk. That's a market risk. And what are the major components of the market risk? Like the interest rate, the foreign exchange rates, or equity rates, or commodity rates. These are the different components of the market risk, right? The fourth one, it's about the operating risk or operational risk. Now, what is operational risk? When there are system failures, when there are internal frauds, when there are external calamities, right? So due to which the you face huge losses, that's the operational risk. Now the losses could be due to the inadequate or failed processes. It could be due to the human error or frauds. It could be due to the system failures. Like you want to work, what your system is not working and you faced a huge loss, right? So that's the operational risk. Like process failure was there, human errors were there, internal fraud was there, cyber attack was there, weak internal controls were there. That's basically what, that's the operational risk. Clear with it? After that, the topic is related to the credit scoring. So I've already given you idea in the previous topic also, that's what is credit scoring. So it's a statistical method. Why I'm saying statistical method? Because it's a number that you'll be getting right from the credit information report, which we say to be CIR, right? So it's a number that you're going to get, and further the banks or the lenders are going to get so as to evaluate the credit worthiness of the borrower. So the main thing is related to, we want to check the credit worthiness of the borrower, of the individual. Not, we are not going to say borrower. By why borrower? Because the individual is just an applicant right now when we did check the credit information report, right? So what is the main objective of the credit scoring? Because it is give you an objective way. It's not a subjective way. It's not a tedious one. You just to basically input the proof details, that the identity proof detail, address proof detail, and the other details required by the credit information company, and you'll be getting all the details about it. That what particular past facilities which were availed by the customer, what are the present facilities which are right now going on, and also if there was some delinquency in the past or something like that or not, right? How was the repayment previously? So in a way we can be reducing our default risk because we know somewhat about the customer now. We can be it can be helping us so as to do the standardized evaluation. That's very much important. That's the main thing, that it has made the lending decisions very much faster. That's why you must have heard about that you can get the loan in just 10 minutes. How it is possible? Because it's just a credit report that you need to draw. You're having some standards related to that. If your credit score is between this number and this number, it means you're getting a good loan. Okay, so that's about it. And there are different factors which are considered in like credit scoring. It does look into the credit history. It does look into the credit utilization. Like if you have utilized 100% of the net worth, or let's say 100% of the amount which was sanctioned to you, then definitely you will be having a lesser score. It also look into the types of the credit facilities, or the, let's say if you're having multiple credit inquiries in the past, then also your score will be lowered one. So there are multiple factors which are considered in the credit scoring, right? So it's a numerical representation. The credit score is what? It is a statistical number. It's a number which will be given to you. Like I told you, it is ranging from 300 to 900. 900 is considered as a good one, strong score, and 300 is considered as a weak score. So if you're having a very low score ranging from 300 to 549, it means you're having a poor score. If you're having score from 550 to 649, it means you're having a fair score. If you're having score from 650 to 749, it means you're having a good score. And if you're having the scoring from 750 to 900, it means you're having a very good score. So the minimum score is 300 and the maximum score is 900. So if you're having good score between, let's say, 600, 700, 800, if you're having 800 score, it means you'll be getting the easy loan approval. But sometimes we also get the score as -1. -1 indicates no credit history. We never find the credit history. The fresh appraisal is to be done in that scenario, right? Then it's about the CIC, that is a credit information company. Now, what is CIC? It is a credit information company, like is an institution which is going to collect the data, which is going to store the data, which is going to process the data, and also it is going to disseminate the information when the credit reports are drawn, right? So credit information company is an institute. It's an institute which collects the data and further maintain the records. So just like the part, let's say we are talking about the CIC, it's going to fetch the data from its members. The all the banks are required to be members, or financial institutions are required to be members of the CIC, right, as per the current ruling. And further, this CIC is established under the Credit Information Companies Regulation Act, CICRA. We say to be CICRA, Credit Information Company Regulation Act 2005, and regulated by the Reserve Bank of India, right? So whatsoever the loan facilities which will be sanctioned by these financial institutions and banks, though that particular loan facility data, that what amount was sanctioned, what is the repayment on monthly basis, or let's say, or even on higher frequencies, the data will be shared by the financial institutions and the banks with the CIC. The CIC is going to store that particular data, collect that particular data, and is going to analyze the particular data, is going to process that particular data in a particular manner. Okay. And whenever information is required by any of the member institution, they are going to draw a report, and that particular data related to that particular customer will be given in a preferred format. That's about the CIC, that how the CIC is going to work. So it's going to collect the data, it's going to store the data, it's going to generate the credit report, it's going to, let's say, do the credit score calculation and risk assessment. So it's not the final decision, but it's never the final decision. The final decision is always with the lender. It's just a platform which is going to tell you that what score the customer is having, but it's not a final score. It's not a final decision. Okay. And the credit information companies, as I told you, in India, these are licensed by the Reserve Bank of India, governed by the CICRA, that is Credit Information Companies Regulation Act 2005. Now it's about the CICs in India. CICs in India. So we are having the multiple CICs, like we are having the TransUnion CIBIL. We are having the TransUnion CIBIL first of all. CIBIL is the most common one. This is a credit bureau established in India, right? This is the first credit bureau which is established in India, and it was established in 2000 and started its operations in May 2004. And further, it is having more than 500 members as their basically CIBIL is having more than 500 members, and there are more than 200 banks who are basically the members of the CIBIL, and it is most widely used credit score by the banks in India. The next one, it's about the Experian CIC. Experience, but this is an international credit reporting company. which is operating in India through the joint venture, right? So in India, it was established in 2006. In India, it was established in 2006, right? And further, if we look at the Equifax, the another one, Equifax is CIC. It's a global credit reporting agency. It's a global credit reporting agency which is headquartered in Atlanta, right? And it started its operations in 1899, but in India, it started its operations in 2010, right? Regulatory is same, Reserve Bank of India, and then it's related to CRIF, High Mark Credit Information Service. So CRIF, High Mark, is basically focusing on retail, agriculture, rural, MSME, and this is basically related to commercial lending and the microfinance sectors. It provides a credit information for the microfinance and the rural borrowers, right? And it is serving the banks, microfinancial institutions, and NBFCs. Clear with it? After that, it's about the membership to the CICs. That who is to be the member of the CIC? It is basically required by each and everyone, or whatsoever the process is. So, what's the main process related to it? Who should be the member for the CIC? That's about it. So banks and for the regional rural banks, the cooperative banks, NBFCs, public financial institutions, housing finance institutions, these all are required to be the membership, and the membership is available to them all, right? And if they become member, they are to submit the borrower credit information, right? Who is a member? Only that particular person or that particular member can be assessing the credit reports through the CIC, right? So banks, RRBs, cooperative banks, NBFCs, public financial institutions, housing finance institutions, and even the let's say companies who are engaged in the business of the credit cards and similar cards, they can become the member of the CIC. And as per the CICRA, that is a Credit Information Companies Regulation Act 2005, right? The main objective of the CICRA was to regulate the credit information companies. That how CICs can be regulated, because it empowers the Reserve Bank of India so as to regulate the CICs. It ensures proper collection and sharing of the credit information, and it's going to protect the confidentiality also. It's going to protect the confidentiality also. We are having the two sections we are going to talk about. One, it is a section 15, section number 15, that every credit institution, every single credit institution is to become mandatorily a member of the at least one CIC, right? And section 17 says what? Section 17 says that CIC can obtain the credit information only from the members. So as per the section 15, it is mandatory that every credit institution is to become member of at least one CIC. And section 17 says that only the CIC can be collecting the data only from the members. And what is the current scenario? That all the banks, concerned financial institutions, like we discussed above, they are to become members of all the CICs. Like if there are 4 CICs, we are to become member of all the 4 CICs. And then it's about the membership fees. So the maximum limit for the membership fees is rupees 10,000, and further for the annual renewal fees it is rupees 5,000. So it cannot be exceeding this particular amount. And CICs basically build scores using the 3 historical data files. One is related to the defaults on previous credit transactions, the payment behaviors, the previous searches and inquiries. These are the 3 main factors. Like what were the facilities that you have taken, how you are basically repaid the amount, what is your payment behavior, that's basically repayments, and the third one about the inquiries. So more the inquiries, lower would be the number. After that, it's about the managing the credit score. Like if you want to maintain or improve the individual's credit worthiness through responsible financial behavior, that is said to be managing the credit score. The first thing, it's about the credit utilization. Like I told you, let's say if you have sanctioned a credit limit of 500 lakhs, right? And you're utilizing 500 lakhs, or let's say you're utilizing most of the times 480 lakhs, 80, 90%, 70% usage is there. Definitely you'll be having the lower credit score. Let me just give you a simple example. Let's say you are having a credit card limit of rupees 1 lakh, and if you are utilizing, let's say 70,000 or plus, then you'll be having a negative impact. So above 50%, you may be having the negative impact. The second one, it's about the payment defaults. Definitely, if there is a default, you are not able to pay off your obligation, payment obligation, there will be reduction in the credit score. So there will be reduction in the credit score means what? That will be facing difficulty in obtaining the loan, or the loan will be available to you at a higher interest rate, or negative credit report entries would be there, right? And the third one, it's about the trade attributes. Trade attributes means that will be considering your payment history, your credit age, the types of the credit accounts, and recent credit inquiries. Payment history means record of past loan payments. Credit age means length of the credit history. So if you have taken, let's say 5 loans in 1 year, or you have taken 5 loans in 10 years, definitely if you have taken 5 loans in 10 years, then you're having a good score. So when your credit age increases, your credit score also increases. If you're having a good payment history, the credit score will be good. If you're having a good credit mix, your credit score will be good. But if you're having more recent credit inquiries, your credit score will be lowered. Right? Now, what are the warning signs of the credit score? Like if you're doing the late payments, or credit utilization is very much higher, higher debt level, multiple credit applications, foreclosure or OTS was there, inaccurate or suspicious information is there. So these are the warning signs in the credit scores. Then it's related to the CIR, that is a credit information report. So it's a report which is drawn. Let's say the bank is going to draw the report from the CIBIL. Bank is going to draw the report from the CIBIL, right? You draw the particular report. This report would be the complete detailed document which will be telling the complete credit history of the individual or the business. That is said to be CIR. So it will be showcasing the personal information. What things it will be showcasing? It will be showcasing the personal information, and also it will be telling about all the credit accounts, and also it will be telling about the repayment history. It will be telling about the repayment history, about the credit inquiries, right? And the credit score. So that all information will be available. And what is the benefit of basically using the credit information report? It will be helping you for the financial analysis. Like it will be providing you clear picture of the financial health. It will be helping for the debt management. You will be knowing that what existing borrowings are there. It will be helping you so as to monitor them. And for the better credit decision can be made. Definitely, you know better things. Now, it might be the case that the customer is hiding something from you, but that will be clearly showcased in the credit report. And it will be helping you a lot for the financial discipline. Like it basically encourage the timely repayments also. Now, this is not just from the, let's say, from the member point of view, but also from the individual's point of view. CIR can be helping you a lot. Like if I think from the individual point of view also, it is going to help us for the financial analysis. We can be analyzing the things from the member point of view. From the debt point management point of view, it is going to help the member as well as the individual, and better credit decisions. Like for the members, the benefit is their financial discipline. It's going to help the individual. And what are the factors leading to favorable credit score? Like if you are doing on time repayments, that's the most common one. If you're doing the on time repayments, regular payments, and paying the credit card bill in full. Like if you're avoiding the over leveraging, what is leveraging? Like if you're having the net worth of 50 lakh, and if you've taken the loan of, let's say, 100 lakhs or 70 lakhs, that's a leveraging. So if you're maintaining strong financial records, proper utilization, then definitely it's going to help you a lot. And factors leading to negative credit score, like excessive credit inquiries being made, check bounces, irregular loan repayments, or defaulting in the payments. And let's say if you're taking too much unsecured credit, unsecured advance, like let's say if you're taking the personal loans a lot, credit cards a lot, right? And let's say if there is a rejection of the unsecured loans or defaulting as a guarantor, even if you're a guarantor and you have defaulted as a guarantor, that will be showcased in your CIR. Okay. And high utilization of the approved credit limits, non-payments of the utility bills, errors in the credit records, that all will be showcased. That all will be showcased in your CIR report. Clear with it? And what are the advantages? If you're basically paying off everything, then definitely you'll be having a good credit score. You'll be getting the loan approval quickly, and further, you'll be offered with the good interest rate, and flexible repayment options can be there. And the bank can also be waiving off you with the processing fees or something. So these will be the advantages which will be available to you if you are doing prompt repayment or early payments, or if you're having a higher credit score. Then it may also be the case that there are some mistakes in the credit scoring. Now, sometimes what happens, like the CIC is dealing with crores of the peoples, like not lakhs I'm talking about crores of the people. Now, it could be the case that the names are identical in the CIC database. So it could be the case that when fetching the data, we were to fetch the data related to Ramesh Prasad, but the data was fetched related to Ramesh Prasad, right? A very identical name. So mistakenly it could be showcasing someone else's report, right? So that could be the one of the error, right? And further, it could be the human input error also, that whatsoever the data which was submitted by the members to the CIC, that incorrect data was submitted, or the wrong account mapping was being done, or inaccurate repayment records were being sent by the member to the particular CIC. Or it could also be related to identity theft, when someone tried to impersonate someone, right? So someone basically opening the fraudulent credit card, or taking loans using the stolen identity, or unauthorized financial transactions were there. So these could be some of the issues related to the mistakes in the credit information report related to the credit scoring. Then how one can be troubleshooting these credit scores? So first of all, we need to do what? We should be connecting with the bank. How we can be troubleshooting? First of all, we should be connecting with the bank. We should be getting the CIR number from the bank about the report which was drawn by the member bank, right? So let's say if you're having a mistaken information in the credit information report, then you should be getting the control number, because every single report which is drawn related to the customer, it's basically having the control number. We should be getting the control number from the bank, right? We can be asking them so as to provide the control number which is associated with the credit report. So we are to first of all get the control number. This is very much important. Now, once the lender is providing you with the control number, the borrower can be getting the detailed information from the credit information company itself using this unique identifier. So control number is what? This is a unique identifier, and it can be helping us so as to report the basically report the tracking. And this is also a verification tool also, like using the control number you can be verifying the data online also, right? So that can be done. And further, through the CIC also, the customer can directly be writing to the CIC, but it should be always be advisable that the customer is having the control number, and customer has requested the bank so as to ask the CIC so as to make the changes. So through the control number, through the bank is going to ask the CIC so as to make those changes to it. Clear with it? So step one would be related to that we need to identify the incorrect information in the credit report. Step 2 would be related to we are to approach the concerned CIC, and we can be submitting the dispute request with supporting documents through the bank. It's advisable, and CIC is going to forward the dispute to the concerned bank, and bank is going to verify and correct the data if the error is there, right? So CIC will be acting as the intermediary, because the application will be sent through the bank to the CIC, or you can directly be sending the application to the CIC, and CIC will be sending the data or the request to the concerned bank. Bank will be looking into the data if there is some error or not, and further will be reverting back, and that is how it will be corrected. So CIC is acting as an intermediary. It is acting as intermediary. So I hope that all the things must have been clear to you so far. So if you're clear with this thing, kindly please do confirm the same. And that's all about the chapter number 7 of the credit scoring, right? Credit scoring chapter is all done. And that will be all about this video. Thank you so much, and see you again in the next video. If you want to get the complete course of JAIIB, the course is available in English only language also, and also the bilingual course is available. Simply just do WhatsApp JAIIB to the number 83609 44207, and I'll be sharing all the details with you. So thank you so much, and see you again.